Get out now. I'm Steve Van Metre. Markets are crumbling, the dollar's collapsing, and investors are fleeing. As you're about to see, the dollar's at risk of losing its safe haven status. Plus, we have a sponsor of today's show. I'd like to welcome Biovaxis Technology back. You can find them on the CSE under symbol BIOV and on the OTCQB under symbol BVAXF. And they're a clinical stage biopharmaceutical company developing immunotherapies for cancer, infectious diseases, and immunological conditions. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg where we find out why investors are dumping the dollar, and perhaps you should too. As Trump's push against Powell has the doubts of the U.S.'s safe haven status, and this is a major risk not only to the dollar but the U.S. economy that's already slowing down. And I've made the argument that we're going to put up trade barriers, that consumers need some form of fiscal relief, whether it's direct injections of money or tax cuts. But the problem is we need the tariffs to fund the tax cuts. Due to all the money spent during the pandemic and the years after, we have no latitude for fiscal stimulus. Now, the good news is we've seen gas prices come down, giving some relief to consumers, but the last lever to pull, well, that would be interest rates. And we've talked about how the Fed doesn't want to move right now because they're afraid of inflation. So the threat from Trump that he could undermine the independence of the Fed, well, it's threatening to do two things he doesn't even want right now, and that is to drive inflation higher and send the U.S. economy right into a recession. At a moment in which the administration has already instilled ever higher levels of uncertainty in the economic outlook, any attempt to remove Powell will add to the downward pressure on U.S. assets. And that's exactly what we're seeing today. Over the weekend, the news really got pushed that Powell could be removed, even though the evidence suggests it is highly unlikely. But look at how the market's reacting. Stocks are selling off, bonds are selling off, the dollar's selling off, and there's panic as everyone right now wants to get out of their dollar-denominated assets. And what do they want to hold? Well, anything else. Because Trump's musing on the potential firing of Fed Chair Powell, even if such thoughts don't come to fruition, do in the minds of the international community as they constitute a substantial threat to the independence of U.S. central bank and, by extension, the status of the dollar as a safe haven currency. And so normally during times of crises, people look to the dollar, they look to treasuries, and right now they're really concerned that perhaps if the Fed's independence is undermined, that the dollar will lose its safe haven status, so they want out, and they want out fast. Should the U.S. fall into a recession with a central bank that either does not or cannot act independently, there's a chance a downturn could be exacerbated, giving markets even more reason for concern, because we've seen when central banks aren't independent and governments have control over them, what happens during downturns? The printing press gets turned on. And while a lot of people think QE was printing money, it wasn't, but we've seen central banks actually print money. It creates hyperinflation and destroys economies, and that's what everyone is afraid right now if President Trump were to take over the Fed. Several hedge funds were among those selling the dollar on Monday, and the lower it goes, well, the more likely people are going to sell. And right now, when we look at a chart of the dollar, we see no bottom in sight, and there's a huge risk here because a falling dollar could lead to massive inflation in the U.S., and in that case, the Fed would need to keep interest rates tight. The problem is Trump wants them to cut and cut fast. And we're seeing money flow into Japanese super long bonds that drew a record foreign inflow last month. This heightened risk aversion amid tariff policy burnished the securities allure as a haven. And we talked about this in the show the other day, that the yen and Japanese JGBs are seeing massive inflows. And it's all in direct response to people's fear that the dollar is going to lose its safe haven status. Now, I want to know from you, should the government be in charge of the Fed and direct monetary policy? Should the Fed remain independent? And are you concerned that we're going to lose our safe haven status? Weigh in the comments below, because global funds brought a net 2.18 trillion yen of the nation's debt with original maturities of more than 10 years, and net purchases across all tenors total over 6 trillion yen, the second highest on record dating back to 2004, as everybody's ditching dollar-denominated assets. And while legal scholars say that the president can't dismiss a Fed chair easily, and Powell said he wouldn't resign if asked by Trump, the speculation is dealing U.S. assets a fresh blow at a time they don't need any more uncertainty. Washington's aggressive trade tariffs have already fanned fears of recession and fueled doubts about the status of treasuries as a haven of choice. And that's the truth here, because when we look at tariffs, it's a tax, and we know it's going to drive consumer prices higher. And the issue here is that consumers are not seeing their pay increase enough to offset that. And we've talked about this before, that puts us right into a stagflationary environment. And historically, that is the exact recipe for every recession. But when you put uncertainty over the helm of the Federal Reserve and its independence, well, it also starts to put into question of the safe haven of treasuries, which is something that would cause interest rates to go up. And that is something consumers right now don't need. During recession, they want to see interest rates go down as people buy bonds. And right now, it isn't looking like that's going to happen. And central bank independence is so valuable, not something to take for granted, and so difficult to win back if ever lost. Threats against power are not helping foreign investors' confidence in U.S. assets, but I think that tariff updates are the main drivers. So in addition to the fact that there's already uncertainty over tariffs, now there's uncertainty over the Fed's independence. So Trump's move here to potentially oust Powell is working completely against him, because it's leading to more uncertainty. What he should be doing is standing behind the Fed, saying, I completely support them, and that would give people confidence in U.S. assets, which is exactly what he needs. He needs money to flow into U.S. stocks and to bonds and the dollar, and right now he's getting the exact opposite reaction by the market. The latest catalyst for dollar selling might have been pressure on Powell, but the reality is that no further justification for U.S. dollar selling is needed. What has already happened over the past 3 months is justification enough to warrant ongoing U.S. dollar selling, perhaps for months to come. And that's a major issue here, because people are looking at their dollar holdings, they're seeing it losing value, and they want to hold virtually anything else. Now, I want to know from you, are you unloading your dollars and putting your money somewhere else? What are you buying? Is it gold? Is it crypto? What are you buying? Weigh in the comments below, because I'd love to hear from you. Even if you're holding on to your dollars, I want to know why. Because let's talk about the risk for the U.S. economy and why it could push us right into a recession. As we take a look at the consumer price index in blue against the nominal broad U.S. dollar index in red. And what we tend to see is periods where the dollar goes on a long trending decline, it leads to higher inflation. You can see that happen going into the global financial crisis. You can see it between 2010 and 12, where you see the dollar decline and inflation rise. We see it happen again around 2017. The dollar goes down, and next thing you know, inflation is back on the rise. You see it after the pandemic, and now on top of the fact that tariffs are likely to send consumer prices higher, the risk is a weakening dollar could send them up even more, and that is a major issue for consumers, again, who are not keeping pace with inflation. So we talk about the risk not only from a safe haven status, but we also talk about the economic risk, and that is a real one. As we now take a look at the consumer price index against total income for production and non-supervisory employees, and I want you to see is that when periods where inflation is rising and incomes are falling, you go right into a stagflationary environment, and then you can see with nearly 100% certainty you get a recession, which is exactly what we saw going into the 1971 recession. And then you see the 1974 recession. Once again, inflation rising, income slowing. You see it happen again going into the 81 recession, then the 82 recession, the 91 recession, the dot-com bubble, global financial crisis, and now potentially where we're headed right now. And again, it makes perfect sense, because if incomes are going down and prices are going up, that means workers can't afford as much. And when they can't spend as much into the real economy, that leads to a broad decline in demand. And that means, again, a decline in demand for labor as people get their hours cut and they lose their jobs, their spending goes down, and it backfeeds right into a recession. And consumers are worried about inflation, as the University of Michigan noted in their latest survey, showing inflation expectations surged higher. But you'll notice there's a strong relationship between inflation expectations and gas prices. And with pump prices trending lower, the question is, are gas prices likely to head up, or are inflation expectations going the wrong way? But the bottom line here, if consumers believe inflation's going higher, there's going to be two things they do. First is front run the tariffs, which they've already done, and then then the next thing they're going to do is they're going to cut their spending and increase their savings because they're going to realize they can't afford the things they want. So they're going to have to start saving more money to be able to afford things in the future. And again, as they do that, demand goes down, it blackfeeds right through the economy and then impacts the labor market. And all this uncertainty is turning right into the markets as we saw stocks, the dollar and treasury all tumble, and yet Bitcoin and gold are soaring. I want to know from you, is that what you're buying? Are you dumping the dollar for gold and Bitcoin or something else? Weigh in the comments below, because the dollar is set to have its worst day in 2 weeks, plunging now to a 15-month low as investors are want out and fast, sending precious metals soaring. Gold was above 3,400. Energy prices are down as an indication that demand for the economy is weakening and validating that we're heading into stagflation. Because again, as prices go up and incomes don't keep pace, consumers spend less money, less demand for energy. Ags and base metals are higher. There's also trouble in trade deal land, with Japan pushing back on U.S. demands, while China is warning trading partners against any mistreatment in any deal made to the U.S. Again, adding to more and more uncertainty about the economy. But the Fed's standing up for its independence as Fed's Goolsbee warns against curbing central bank independence. There's virtual unanimity among economists that monetary independence from political interference, that the Fed or any central bank be able to do its job that it needs, is really important. I strongly hope we don't move ourselves into an environment where monetary independence is in question. That would undermine the credibility of the Fed. Now, I would argue the Fed has no credibility because there's no relationship between monetary policy and inflation in the labor market, as they like to suggest. But the reality is consumers and market participants do believe in that relationship. They want an independent Fed, and right now it's being put into question. And Goolsbee said that countries where central banks don't have monetary independence, well, the fact is inflation is higher, growth is slower, and the job market is worse. And he's absolutely right, because what governments do anytime there's a downturn, they just turn on the printing press and print more money. It leads to hyperinflation, it leads to lower economic growth, and of course, we know a weaker job market. And the evidence is clear if we can go back and look at periods during the U.S. where the consumer price index surged higher, and we can overlay the unemployment rate, and you can see periods of rising inflation lead to higher employment. So you can understand now why market participants want an independent Fed, because they believe in the power of the Fed. And you can see that here going to the 91 recession, the dot-com bubble, the global financial crisis. And we can see now that not only due to the tariffs, the falling dollar are going to lead to higher consumer prices. At the same time, income growth is flat and slowing, and that's going to lead to higher unemployment as demand for the economy falls, and more importantly, demand for labor. Again, you can see the setup here of why this is not just bad news for the dollar or the reserve status, but bad news for the U.S. economy as well. And Bill Dudley, the former president of the Federal Reserve Bank of New York, is backing Powell and the Fed's independence, as he said the Fed needs to be patient for 4 reasons. First, the economic outlook is unusually cloudy. There's no precedent for the rapid increase in U.S. tariffs that have been far larger than Fed officials anticipated. And knowing how to respond to an unprecedented change in trade policies is difficult on its own, but even more so when those policies are in flux, and even worse, as I've made the case, that as fast as they went up, they could go down. So the Fed doesn't want to be seen responding to what the government's doing. They want to be seen as responding to the data. The data is what makes them independent. And second, the growth potential of the U.S. has fallen abruptly and sharply. The shift in trade policy will undermine productivity growth, because in the short run, productivity will be hurt by the rise in import prices, which will provoke U.S. manufacturers to readjust. Well, what that really means is demand is going to go down. As demand goes down, well, workers, their productivity falls. And as their productivity falls, well, it means more people hit the unemployment line, validating that the U.S. economy is indeed likely to slow down already due to the tariffs. And third, was inflation on track to exceed the Fed's 2% objective for the 5th consecutive year. Policymakers need to be careful to avoid making a mistake that could cause inflation expectations, which, as the University of Michigan already said, are headed higher, but for them to become unanchored. If that were to occur, well, that means inflation would surge higher, and the Fed would need to respond at a time when the government, if they were in charge of the Fed, would want to cut rates. So you can see right now that President Trump, he needs inflation to come down in a big way. He needs money to flow back into U.S. assets. And by talking about removing Powell from office, he's having the exact opposite effect he wants. And the need for patience is also higher, giving President Donald Trump's attacks on the Fed's independence. If officials were to cut rates and this was interpreted as caving to the White House pressure, confidence in the Fed's ability to contain inflation would diminish, pushing up inflation expectations. Because of this, Trump's pressure on the Fed is counterproductive. As I made the case, not only does it increase the motivation for the Fed to wait, but it makes households and businesses more concerned about the inflation consequences should the Fed's independence come to an end. So now you start to understand why past presidents rarely, if at all, comment on central bank policy, because they understand that the Fed needs to be independent, the markets need to see him being independent, and businesses and consumers need to see him as independent. Whether or not we could argue the case where Fed policy actually works, the bottom line is people need to see a central bank independent from the government, and right now that's putting a lot of question in people's mind, which is why they're dumping the dollar and dollar-denominated assets. But the risk here isn't that it just puts the dollar's safe haven status into question. The other issue is the U.S. economy is already slowing down, and in a big way. And here we can see the Conference Board's headline index has decelerated rapidly with this March data, now plunging 0.7%, the biggest drop since October of 2023. And that said, the data does not suggest a recession has begun or is about to start, but if the dollar continues its downward trend and it leads to a rise in inflation, what we can tell is it is going to lead to a recession. The problem is it's going to lead to the worst kind, a stagflationary recession. And yet the Conference Board downwardly revised our U.S. GDP growth forecast to 2025 now down to 1.6%, which is below potential. The slower projected growth rate reflects the impact of deepening trade wars, which may result in higher inflation. Well, it's likely to do that. Supply chain disruptions, which we're already seeing, and less investing and spending, and more importantly, the biggest issue, a weaker labor market. We know President Trump doesn't want that. He wants to create U.S. jobs because he understands if people have jobs and they make money, they spend it. But the problem is this trade war is set to undermine the entire U.S. economy. And while the LAI 6-month growth rate ticked down in March, it remained well above the recession threshold. That is for now at least. But if we see the dollar continue to plunge and investors dump dollar-denominated assets, it means inflation here in the U.S. is likely to surge well beyond the expectations of the tariffs. And if that happens, we could easily see an unwinding of the labor market because we already know that worker pay is not keeping pace. That means demand's going to go down. It's going to reverberate all through the supply chain and ultimately lead to hours getting cut and jobs getting cut, and the U.S. economy headed right into recession. But something we are bullish on is a stock for our sponsor for today's show, Biovaxis Technology. You can find them on the CSE under symbol BIOV and on the OTCQB under symbol BVAXF. Everything you need to know in the pinned comment and description below, because they're a clinical stage biopharmaceutical company based in Canada developing immunotherapies using its DPX platform and haptenics neoantigen platform for cancer, infectious diseases, and immunological conditions. Its pipeline includes phase 2 candidates for lymphoma and ovarian cancer, and for BVX-0918, a personalized vaccine entering phase 1 for late-stage ovarian cancer. And they're a clinical stage biopharmaceutical company dedicated to improving patients' lives with novel immunotherapies based on its DPX immunoeducating technology platform and its haptenics neoantigen tumor cell construct platform for treating cancers, infectious diseases, antigen desensitization, peanut allergy, and other immunological conditions. In February 2024, Biovaxis acquired all IMV Incorporated intellectual property and development assets, including a portfolio of 120 patents spanning oncology, infectious disease, and immunology. This acquisition enables the integration of IMV's DPX platform with Biovaxis' haptenics neoantigen platform and ovarian cancer program. And Biovaxis acquired all IMV IP for $1 million, consisting of $750,000 in cash and $250,000 shares, resulting in a complete wipeout of IMV's equity and a 96% haircut to IMV's secured creditors. The company believes it's significantly undervalued compared to its peers based on its DCF valuation and its historical R&D expenditure. Biovaxis presents a highly undervalued investment opportunity with a robust scientific platform, including over 120 patents in clinical stage oncology assets supported by human proof of concept data. The company benefits from broad licensing potential, a highly experienced R&D focused leadership team, and near-term revenue prospects through licensing agreements with Sprayvax and Zoetis. And let's talk about some of the recent headlines as Biovaxis partner Sprayvax for Wildlife Inc. scales up vaccine production capacity. And they announced that their Madison, Wisconsin facility is now capable of producing advanced contraceptive vaccines, including Sprayvac and a new GnRH vaccine supporting larger scale production for field trials and market launches. The expanded capacity has already supported major projects such as feral horse population management in Europe and ongoing trials with government and industry partners. This development aims to accelerate the delivery of wildlife, agricultural, and aquaculture fertility control solutions, leveraging Biovaxis' innovative vaccine platform technology. And they have announced a private placement offering. Let's take a look as they plan to raise up to 1 million Canadian through non-brokered private placement of up to over 14 million units, each consisting of a share and warrant with proceeds intended for working capital. The offering is subject to regulatory approval and securities law restrictions, including hold periods and limitations on U.S. sales. And Biovaxis shares some new data on its DPX Immune Educating Platform at Personalized Cancer Vaccine Summit. Let's take a deeper look as they presented a new study at the Boston-based Personalized Cancer Vaccine Summit, demonstrating that its DPX platform with tumor neoantigens effectively inhibits tumor growth and outperforms common adjuvants, showing comparable efficacy to cell-based vaccines. The study found that its DPX formulations may have immune-stimulating properties even without packaged cargo peptides, highlighting its potential for targeted, long-lasting immune responses in cancer and infectious disease applications. And you can find Biovaxis technology on the CSC under the symbol BIOV and on the OTCQB under symbol BVAXF. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.